Global financial markets slid sharply as investors reacted to an escalation in geopolitical and trade tensions between the United States and Europe, triggered by renewed rhetoric from President Donald Trump over his demand for U.S. control of Greenland. The sell-off gathered momentum on both sides of the Atlantic, reflecting growing concern that the dispute could evolve into a broader trade conflict with significant economic consequences. In the United States, stocks fell decisively on Tuesday, the first full trading session after a public holiday. Wall Street opened to heavy selling pressure following Trump's announcement that new tariffs would be imposed on imports from 8 European countries. By mid-session, the S&P 500 had fallen by around 1.2%, while the Dow Jones Industrial Average was down roughly 1%. The technology-heavy Nasdaq index fared slightly worse, dropping about 1.3%, as investors moved away from high-growth stocks that are typically more sensitive to uncertainty and shifts in global trade conditions. Large technology companies were among the hardest hit. Shares in Amazon, Tesla, and Nvidia each fell between 2% and 3% shortly after the market opened, erasing billions of dollars in market value. These declines reflected both broader market weakness and concerns that retaliatory tariffs or reduced global demand could weigh on earnings for companies with extensive international exposure. The downturn was not confined to the United States. In the United Kingdom, the FTSE 100 index dropped about 0.8% on Tuesday, extending losses from the previous session and putting the index on course for its steepest single-day decline since November. Across continental Europe, the mood was similarly negative. France's CAC 40 index fell by roughly 0.7%, Germany's DAX declined by about 1%, and Italy's FTSE MIB dropped approximately 1.1%. Investors across the region appeared increasingly uneasy about the prospect of escalating tariffs and the potential damage to already fragile economic growth. Currency markets also reflected the shift in sentiment. The US dollar weakened, falling about 0.9% against a basket of major currencies as traders reassessed the outlook for the US economy and global trade flows. The move suggested that confidence in the dollar as a safe haven was being challenged by fears that aggressive trade policies could ultimately hurt U.S. growth as well as that of its trading partners. At the heart of the market turmoil were Trump's latest threats to raise tariffs on goods imported into the United States from Germany, France, Denmark, the United Kingdom, Sweden, the Netherlands, Norway, and Finland. The measures were explicitly linked to his demand for negotiations over the complete and total purchase of Greenland, an autonomous territory within the Kingdom of Denmark. According to Trump's statements, the tariffs would begin at 10% on 1 February and rise to 25% by 1 June if no agreement were reached. The rhetoric reignited concerns about economic uncertainty and policy unpredictability, particularly because it tied trade sanctions directly to a geopolitical objective that European governments have repeatedly rejected. Greenland's political leaders and Denmark have both stated that the territory's future is a matter for its own people to decide, and that it is not for sale. European leaders and officials sought to calm tensions publicly. The UK Chancellor, Rachel Reeves, speaking at the World Economic Forum in Davos, urged restraint and de-escalation, emphasizing that cooler heads were needed and reiterating that decisions about Greenland's future belong to Greenlanders themselves. Her comments reflected a broader European effort to avoid inflaming the situation while preparing for the possibility that tariffs could be implemented. From the U.S. side, Treasury Secretary Scott Bessent also addressed the issue in Davos, warning European countries against retaliating. He argued that earlier market panics over tariffs had proven overblown and urged governments and investors to remain patient. Besant suggested that escalation would be the worst possible response and encouraged leaders to wait and see how the situation developed. Despite these reassurances, analysts said markets remained unconvinced. Kathleen Brooks, a research director at the brokerage XTB, described the situation as a man-made crisis, arguing that the continued sell-off showed investors believed the economic fallout could deepen if tensions did not ease. According to Brooks and other market commentators, the combination of tariff threats, geopolitical pressure, and confrontational language was undermining confidence and increasing the risk of prolonged volatility. As equities fell, investors sought refuge in assets traditionally viewed as safe havens during periods of uncertainty. Gold prices surged to record levels, rising above $4,700 an ounce for the first time, while silver also reached an all-time high at $95.52 an ounce. The rally in precious metals reflected strong demand from investors looking to protect portfolios against market turbulence, inflation risks, and geopolitical shocks. The market stress was felt unevenly across industries. U.S. cruise operators were among the worst performers, with shares in Carnival Corp, Royal Caribbean, and Norwegian Cruise Line holdings falling by approximately 2.4%, 3.2%, and 5.3% respectively. These companies are particularly vulnerable to changes in consumer confidence, fuel costs, and international travel conditions, all of which could be affected by a worsening trade dispute. Additional uncertainty was injected into global markets by further tariff threats from Trump overnight. He warned of imposing tariffs as high as 200% on French wines and champagne after reports suggested that French President Emmanuel Macron was unwilling to join a proposed US-backed Board of Peace on Gaza. These comments sent shares in companies associated with French luxury and drinks brands lower. LVMH, which owns champagne labels including Dom Pérignon, Moet and Chandon and Veuve Clicquot, saw its shares fall around 2.4%, while Rémy Cointreau, the owner of the Telmont champagne brand, dropped as much as 1.5% before recovering slightly. Taken together, the market movements reflected a sharp reassessment of risk driven by the intersection of trade policy and geopolitics. Investors appeared increasingly concerned that tariff threats tied to diplomatic disputes could undermine global trade, disrupt supply chains, and slow economic growth. Until there is greater clarity on whether the rhetoric will translate into concrete policy action, markets are likely to remain sensitive to developments surrounding U.S.-Europe relations and the future of Greenland. As trading continued through the day and into later sessions in Asia and Europe, the sense of unease deepened rather than faded. Investors showed little appetite to buy the dip, suggesting that confidence had not yet stabilized. Market participants increasingly interpreted the situation not as a short-lived shock, but as the opening phase of a potentially prolonged period of volatility driven by political risk rather than economic fundamentals. Analysts noted that the uncertainty was unusually difficult to price because it was tied to diplomatic demands and political rhetoric, not to a clearly defined policy framework or timetable that markets could model with confidence. In late U.S. trading, selling pressure remained broad-based. Defensive sectors such as utilities and healthcare outperformed the wider market, but even these areas showed only modest resilience. Financial stocks lagged as bond yields fluctuated and concerns grew that trade tensions could slow global growth, reducing demand for credit and investment. Banks with significant exposure to European markets were closely watched. as investors tried to assess how retaliatory measures from the European Union might affect cross-border lending and capital flows. In Europe, futures markets pointed to continued weakness the following day, reinforcing the view that the sell-off was not yet complete. Traders reported higher volumes in derivatives tied to volatility, indicating that institutions were hedging against further sharp moves. Several large asset managers said privately that they were reducing exposure to equities with heavy reliance on international supply chains, particularly those vulnerable to tariffs on manufactured goods, automobiles, and high-end consumer products. The reaction from policymakers continued to evolve as the scale of the market response became clearer. European officials, speaking on background, acknowledged that contingency planning was underway in case the threatened tariffs were implemented. While public statements emphasized restraint and dialogue, diplomats confirmed that discussions were taking place within the European Union about potential countermeasures that would be legally compliant with World Trade Organization rules. The aim, according to officials, was to be prepared without appearing provocative. Greenland itself became an increasingly prominent focus of international attention as the financial fallout grew. Greenlandic political leaders reiterated long-standing positions that the island's future could not be decided by external powers. Statements from Nuuk emphasized economic development, environmental protection, and self-determination, and rejected any suggestion that trade pressure on European countries could legitimately influence Greenland's status. Observers noted that the situation had placed Greenland in an unusually exposed position, caught between major powers and global markets, reacting to decisions far beyond its control. In currency markets, movements became more pronounced as traders adjusted to the possibility of sustained trade disruption. The euro weakened modestly against several major currencies, reflecting concerns about the impact of tariffs on export-driven European economies. The British pound also showed signs of strain, particularly against traditional safe haven currencies, as investors weighed the UK's exposure both as a trading nation and as a diplomatic actor trying to balance relations with Washington and Brussels. Commodity markets beyond precious metals also reflected the shifting outlook. Oil prices edged lower as traders reassessed demand expectations in the event that trade barriers slowed global industrial activity. Industrial metals such as copper, often seen as indicators of economic health, experienced increased volatility, with prices fluctuating as traders tried to reconcile strong long-term demand from energy transition projects with short-term risks from trade disruptions. Market strategists increasingly drew comparisons with previous episodes of trade-related turmoil, but many emphasized that the current situation had distinctive features. Unlike earlier tariff disputes that focused on specific industries or bilateral imbalances, the Greenland-linked threats were seen as more unpredictable because they tied economic measures to geopolitical objectives that lacked clear precedents. This made it harder for investors to anticipate off-ramps or compromises that could quickly restore stability. Corporate responses also began to emerge. Executives from multinational firms declined to comment publicly in detail, but analysts reported heightened concern during calls with investors and advisors. Companies with significant European revenue streams or manufacturing footprints were said to be reviewing contingency plans, including alternative sourcing strategies and adjustments to pricing. However, many executives cautioned that such changes would take time and could not fully offset the impact of steep tariffs if they were imposed. As the story continued to develop, attention increasingly turned to upcoming political events and statements. Trump's scheduled appearance at the World Economic Forum was seen as a potential inflection point, with markets poised to react sharply to any indication of either escalation or compromise. Traders and analysts alike signaled that even small shifts in tone could have outsized effects, given the heightened sensitivity of markets after several days of sustained declines. By the end of the trading day, the prevailing mood remained defensive. Investors appeared less focused on short-term technical indicators and more concerned with headline risk and political signals. The combination of falling equities, a weaker dollar, surging gold and silver prices, and rising volatility suggested a market environment driven primarily by fear of the unknown. Until clearer signals emerged from Washington and European capitals, many participants concluded that caution would dominate and that markets would remain vulnerable to further abrupt moves as the news continued to unfold.